Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for Nasdaq ETF's Cabana Week is Graham Day, Head of Product and Research at Innovator ETFs, to discuss buffer ETFs with large cap tech stocks at their highs. Graham, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much for having me, Jill.
And big tech has been on an amazing run for a number of years now. How sustainable do you think that is?
Yeah, it's a great question. I think it's something that everyone is trying to figure out today. Should I be increasing my allocation to large cap tech? Should I be decreasing it? One of the things that we've seen is if you look over the last 30 years of the Nasdaq 100 returns on a calendar year basis, there have never been 3 consecutive years where the Nasdaq is up more than 20%. The last 2 years, the Nasdaq has been up more than that each of the last 2 years, and so because of that, we think it may be prudent to take some chips off the table. And I think that's where our buffer ETFs are so valuable, because our Nasdaq 100 January series ETF, 1-to-1 on the upside to the Nasdaq 100 to a 12.5% cap, but with a 15% built-in buffer. So that means if the Nasdaq gives you 10%, you're going to get 10%. If the Nasdaq drops 10, 15%, you would be buffered against those losses. It's a way for people to maintain exposure to this space without, with taking some of that risk off the table.
Well, Graham, let's talk about your perspective on the future regulation of big tech. It appears to be that when we think about it from a legislation perspective, that there is agreement on both sides of the aisle here.
Yeah, I mean, I think from big tech, as we talked about, the best days may be behind them. As these companies get bigger and bigger, they fall under more scrutiny, and I think you're going to see people pushing. I mean, Jack Dorsey himself came out saying big tech is very powerful, perhaps too powerful, and so I think you're going to see some increased regulation, which again isn't saying that this is not going to be a good space for us to be in. It's simply meaning that proceed with perhaps more caution than we have over the last 10 plus years.
So when we think about the construction of the buffer ETFs, it sounds like it would be a good tool for advisors.
Yeah, really great tool for advisors. We've had these products in the market for a few years now. It allows even the more conservative investors who otherwise would not have exposure to the technology space to access exposure to tech. And to be able to have that built-in buffer, I think it's a psychological barrier that is very valuable. A lot of people who otherwise would have money on the sidelines, because they know they have a 15% buffer, feel confident investing in large cap tech. That's the benefit of this product. Plus, when you think about, as we were discussing, is it prudent to take some chips off the table? This allows you to maintain the benefit of large cap tech exposure. But if you're wrong, if the market does correct, you've got a known 15% buffer in place. And that's the peace of mind that a lot of advisors are trying to give to their clients.
All right, Graham, great to catch up as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.